Hello and welcome to this Expert Insight session brought to you by Livewire Markets. My name's James Marley and today cash is back. We're talking about an asset class that a few years ago didn't even register on people's agenda, but it is back. And to help me talk about what's going on in the cash markets, I've got Simon Mullumby, who is the head of cash and bonds at State Street Global Advisors. Simon, thanks for coming in.
Thank you.
Let's get into it. Your fund primarily invests in senior unsecured bank debt. What does that mean to the layman on the street? What are you buying?
We're buying the bank notes that are in the top of the capital structure. So as you move into your sub-debt and mezzanine type notes in the mortgage-backed structure, the risk of not getting your money back if things truly go pear-shaped is a real and potential risk. We, State Street Global Advisors, on any given day, run upwards of $500 billion in cash. And we have our own SSGA cash credit team, and their focus is on senior unsecured bank debt. So senior unsecured being it's at the top of the structure, so if something does go wrong, you get first crack at the assets, but it's also the most liquid form of bank debt in the market too. So we have our own credit team that is focused on the top rated and the most liquid bank names in the world.
Mm-hmm. And so why do you like that bank debt and not other forms of corporate credit?
The liquidity profile and also the credit work that goes behind it. So we don't have limit for all banks in the world. We don't have limit for all banks dependent on their credit rating, whether it be S&P or Moody's. Our cash credit team do their own credit work and give us limit for banks that they like. And to that end, we have to have a credit team that is very happy with the balance sheet, the asset liability structure, their liability structure in debt throughout the world. So we like the liquidity profile of banks that we buy, and it's been proven time and time again in times of market stress that a lot of cash assets that were delivering nice yield, were delivering a nice return, become illiquid. And we've certainly experienced that over some of the cycles, which is why the focus now is senior unsecured bank debt, because it does trade and it is liquid in most instances. So we like senior unsecured bank debt, SSGA credit team approved, but also that has a liquidity profile that works for liquidity funds.
I mentioned in the introduction that cash is back. People can get a return in a term deposit.
Yep.
For people that are watching this video, what's the difference in the return that you can get in this bank debt versus a term deposit?
Well, it's going to be a similar return. So I mean, we don't buy term deposits for any of our portfolios, whether they be cash funds, bond funds, or even the credit funds, simply because they are illiquid.
Yep.
And the premise of running a portfolio for our clients is that if they want their money on any given day, or even on a T+2 basis,
yep,
we go to the market, we will sell notes and give them their money on a T+2 basis. Term deposits are illiquid,
yep,
and that's why they don't work in the portfolio. Insofar as spread-wise, I know that there are some banks out there that offer very nice spreads over where the cash rate is, but the portfolio we're discussing that only buys senior unsecured bank floating rate notes, it has a return target of between 1 and 1.5% over RBA. And again,
without liquidity.
Yeah, it's all about liquidity. So we deliver a similar, if not better, return than term deposits, whilst also offering the fact that if you require your funds, they're there on a very short basis rather than waiting for the note to mature.
So if you were to summarise some of the key reasons why people would consider a floating rate fund over just physical cash, what would be your top three?
Over physical cash, you're never going to get the RBA rate. In floating rate notes, as we've just discussed, they do reset on a quarterly basis, and if there is going to be further tightening from the RBA, the Australian money market will start pricing that. So the money market will always price where they think the RBA is going, not just where the RBA is. So if you've got a floating rate note that is resetting over 3-month BBSW and the market has further tightening priced in, you're going to get a coupon miles above the RBA cash rate. And again, if you're not in just overnight cash, which is going to be sub-RBA cash rate, and you're in term deposits, and if the RBA does indeed start to increase rates further, you're locked into that yield that you've got for 6, 9, 12 months, whereas the floating rate note will reset and you've got liquidity.
Okay. when rates were near zero, I imagine the phone probably wasn't ringing quite as much as it is now. How's the drastic moves in rates impacted the opportunity set for you?
Look, there's a lot of opportunities out there for a lot of people, and certainly when rates were near zero, we didn't see a lot of outflows, but we did have clients that were happy to sort of be in a zero rate environment whilst equity was off 30%, whilst bonds were getting hammered. In the current environment where it's where the cash rate is at 4.1 at the moment, it's easy to get a yield well above 4%. So we're still seeing nice inflows. We're also obviously facing competition from people that are out there offering markedly high yields than the cash rate. But again, our focus is on liquidity and the preservation of capital, and that's why our clients come to us, because they know that they have very conservative portfolios that do deliver a nice outperformance over RBA.
Okay. Well, ladies and gentlemen, there's an introduction to floating rate notes, an explainer on why cash is attractive from Simon Mullumby, who's the head of cash and bonds at State Street Global Advisors.